Let's start with the new topic. Good. We'll move to security valuation. This chapter is actually in your book, I think, combination of bond valuation plus shares. I have taken bond valuation separately. I have a habit of taking bond valuation separately. So bond is part of a security only. Reason being, the question comes approximately 6 to 8 marks from this topic. Let me close this off. 6 to 8 marks from this topic, and bond valuation separately we have 8 marks. So appropriate weightage cannot be attached if we do it combined. We will not be able to appreciate that out. Well, the principle remains same. Time value of money is something what we'll be using in. Now, before I move to this topic, let me take up basic part of it. What exactly does this mean? Although lot of methods from the inter are again given back in the finals, I'll quickly just have a briefing of it, although I don't think they'll be asking anything in the finals from here. The main method which they would be asking is dividend growth method or dividend discount method, which interchangeably they use as a Gordon, although Gordon is not the entire DDM, so that's a separate method, but more or less they'll ask you from DDM. This first method, what I am talking about, the Walter method, this has shifted to the inter, so they'll not ask, but what they write in your study material is, following are the methods which you have studied in the inter, and institute reserves the right to ask anything from the inter final or foundation level, which you'll come to know very soon what comes from the foundation level also. This will just give me a helping hand in arriving at a certain valuation parameter. Walter, basically I would not say formula you have to remember. Practically we don't see a lot of usage. Practically means when we talk about the practical industry side, because these were made in, I think, long back, so there is not so much of a usage, but certainly this method talks about one thing which will be using entire FM at final level or inter. That company, if it raises money from investor, that's cost, and the investment when they earn from the asset side, that's basically they raise money here. Investment is done in the asset side. From here, what you earn is called R. This cost is called KE or KO, assuming depending on it, there is only one source of finance. This same principle I look into M&A when some deals happens. Same principle I look into capital budgeting. This is very important, and general parlance you should know. When I as a businessman invest something, if my earning is more than, if my return is more than the cost, then basically it's justified. Keep running the business and keep investing. If it is not, then you have to take a call accordingly. This method talks about different parameters I've just given for a reference purpose. This formula is based on the perpetuity. It's a d by e plus e minus d into r by k divided by k divided by k. In regular class we talk about how the perpetuity formula comes into picture. We are not going into depth. Just keep this for the time being, because final level, since they shifted to inter, earlier this was very common question in the final. After that I have given you one example in which I have taken r as 10 and ke as 12. Walter spoke about two things, because Walter's principle would come handy to me in one of the chapters for some analysis purpose going forward. In this case, my R is less than the KE. It means company, when they are retaining the money, their cost is 12%, whereas if they reinvest, they retain and then reinvest, they are earning 10%. Shareholder would not be happy. Shareholder would say, it's better off you pay us the all money as a dividend. So you would have spoken this earlier also. I just refreshment that in this case the share price would be highest when company pay entire money as a dividend. This was Walter basic thesis. The implication of Walter was this. The implication was, if your R is the greater than KE, we call them as a growth firms. It's better to reinvest in the business. If R is less than KE, it's declining firms. You should have a 100% payout. You should not retain. Payout should be 100%. The retention should not be there, and R normal, anything can happen. Walter specifically, if I speak about, spoke on two things: R greater than KE and R less than KE. The entire principle from here to learn, remember, is for capital budgeting IRR or any kind of analysis, that whenever you are earning more than the cost, it's advisable to reinvest. There could be some question which can be set in the merger acquisition. He'll say, I'm acquiring some company and this is the date of this company. Should I acquire or not? You have to look from a perspective of earning and the cost, which I think I should cover in the revision batch if it comes out. This was Walter, which was from the Inter. Second model which I picked up from the Inter, and the most important theoretical method which I think remains in the Inter final both, is DDM. This is the most important which comes out. Practical life, again I am saying practical life, what model comes in, we'll learn in M&A, or now it has become a business valuation. That's a free cash flow approach. But theoretically, dividend discount method remains the most important method amongst all. No growth, it's a perpetuity formula. It might appear to you it's only a 1 year dividend. Remember the flow of the chart, constraint of a time, I just have to be able to tell you the flow of the chart. D by K is a perpetuity formula. What this formula is doing is, it is basically deriving 1, 2, 3 and infinite dividend and bringing back to 0 period. It's a GP series and some concept comes into. You do not require any kind of a derivation. If someone would have taken the normal classes, you can take the notes from them. They'll tell you how exactly this formula is arrived. So D by K, it's a perpetuity. It's a constant stream of dividends which comes out. I'll be using this formulas in different valuation chapters again. D1 by Ke minus G. This formula you might have done in cost of capital. K is equal to D1 divided by P plus G. That was again a perpetuity formula. In this we are calculating the share price. What price we calculate is generally called intrinsic value, fundamental value or equilibrium price. In common parlance we can call it as a price also. What this formula is doing, if there is a constant growth then stand at 0 period, first year dividend D1, D2, D3 and D infinite. Once you calculate D1, D2, D3, D infinite, either you keep calculating individually or simply apply this formula, you'll arrive at a share price. Dividend discount method have three possibilities: constant growth, middle one, no growth, first one, and different growth. Different growth could be, which is a practical scenario, anyway remains when we are covering any company for the valuation purpose. Up to some year we can do the forecasting. After some point of a time forecasting cannot be done, especially in the country like India. When we are talking about, there could be a possibility, there are different growth stories. For example, now we are standing almost in 2024 and the growth expectation is very heavy. For next 5-7 years there will be high growth in some industries and then there could be a constant growth. So this formula would talk about different growth for some years and then there would be a perpetual growth. Even if there is no perpetual growth, practical life it is assumed after some point of time growth will become perpetual. Fundamental principle as per all three methods will remain is, share price today is nothing but summation of present value of all future dividends. That means if you have a same kind of a growth, then it's D1, D2, D3, D4. If you have a different growth, then till the time you have a different growth, keep calculating dividend individually. For example, if it says current price is D0 is 4 and you have a growth of 10% for 5 years and then there is a perpetual growth of 5% after 5th year. You calculate D1, D2, D3, D4, D5, stop at D5, then calculate P5. P5 is a price which is based on this principle. From wherever growth becomes constant, you can apply a perpetuity formula and arrive at 0 period. Same concept, remember, we'll do in the valuations of the free cash flows. Now I have written some notes here which are based for the first two methods. One more point before I go forward. This method is similar to Gordon, although Gordon gave a formula EPS into 1 minus B divided by K minus B into R. Formula was basically EPS into 1 minus B into 1 minus B divided by K minus B into R. B stands for retention ratio, R stands for return on equity, B into R is nothing but growth and 1 minus B is nothing but dividend payout ratio. So since this formula is similar, your institute has a habit, they write Gordon and they use this formula. And sometimes they use Gordon and they write this formula. Correct formula as per Gordon is this. Since this formula is similar to the constant growth DDM, it is interchangeably used. In exam, if we specifically mention a Gordon, which I don't think now at final he'll ask, maybe by chance if it comes, do write EPS into 1 minus D divided by this, even though he gives full marks for using this. This formula is for Gordon. Dividend discount model. I am talking specifically with respect to D1 divided by K minus G. Understand few points for this. This formula can be applied when growth rate is constant. To arrive at P0, look at the point. You are standing in P0 here. So standing at P0, price 0. P0 would be equal to, we take help of D1. That means I take D1 divided by K minus G to arrive at P0. It means to calculate P4, I will take help of D5. If I have to calculate P4, I have to take help of D5. D5 divided by K minus G. It means if I am standing in 0 period and there is a perpetual growth here, P0 is equal to D1 divided by K minus G. In some question it will say calculate P3. P3 would be equal to D4 divided by K minus G. The formula cannot be applied if company is not paying dividend. Indications, how to find D1, D0 oblique. D1 is words are future, expected, will pay, forecasted. These are the words used for D1. D0, he'll use the words historical, past, paid, last year. There could be some question in which he'll say dividend. Nothing said about forecasted and future. Now actually, frankly speaking, three terms are there. This is past tense, then there is a future tense, then there is present perfect tense. We cannot be the English teachers anyhow. In case you are not able to identify whether dividend is historical, forecasted, do the assumption and do it accordingly. Maybe once we have done this question, I will take up some ambiguous languages of the question, make you understand that what problem comes in a particular question and then what should be the answer which should be done. This is the most important method under which maximum questions would be framed. Different growth method. If you look at this diagrammatical presentation, this I have taken a two-step model. Two-step is when the growth rates are two-stage. In a life of a company, we can have a three-stage. You would have done something called law of diminishing returns also in economics, that growing at a faster pace then becomes kind of a constant and then becomes the slow down and then perpetual growth comes out. Assumption here is the 10% growth for first 3 years and then constant growth after 3 years. Fundamental principle will not change. My today's share price is nothing but summation of present value of all future dividends. I'll calculate D1, D2, D3. We call this as a forecasted period. Forecasted period is a period for which the individual year's dividend can be calculated. Once the growth becomes constant from here till infinite, we calculate P3. P3 is nothing but D4 divided by K minus G. If I indirectly try to look at this, the 0 period, when I bring back discounting, it's a D1 1 year discounting, D2 2 year, D3 3 year, and not to make a mistake, this is third year. Somehow in a hurry we have a problem. We look at D4 and discount by 4 years. I'm taking help of D4 but standing at P3. This will be discounted by 3 years. Now if you try to analyze frankly, P3 is nothing but P3 includes all dividend from 4th year till infinite. That means P3 includes all dividends after 3 years and you separately add back D1, D2, D3 and then arrive at this period. The period for which forecasting can be done is known as a forecasted period. Terminal value is the value of the company which comes at the end of the forecasted period till perpetuity. If the growth rates are different, then dividends of each year should be calculated till the time growth rates are different. Once the growth rate becomes constant, we can apply a perpetuity formula. Forecasted period is a period for which projections can be done. Terminal value, these terms becomes important now, especially from the MCQ point of view. Earlier they were not important. I could have generally said forecasted period, terminal value. Now these terms have gained importance. Terminal value is a very common term. Terminal value is the end value and this comes into picture only when the forecasted period ends. Terminal value is the value of the company from the end of forecasted period till perpetuity. In M&A, I'll tell you the importance of terminal value. Here it's very ordinary term, but the importance would come. There is certain significance, especially in the free cash flow. Same kind of a diagrammatical presentation, importance would come for terminal value. P0, when I stand, P0 is nothing but present value of dividends plus present value of P3 which comes out. So this will remain an important model at different places I'll be using in. Now let me look at, yes, I'll cover up straightforward. We want any basic question or straightforward, I pick up the technical part or technical questions out of it. Let me see the water first. Let's do one thing. Let me do that. Let's cover one by one only. Read question number 12. This could be one of the case studies which can come in the exam. This could be one of the case studies can come in the exam, and do not sleep while reading. Question number 12. CMC PLC. or let me read out. He can give you exactly case study, 3 points and 4 points, and then ask for the answer. So this CMC PLC has common equity capital structure. PLC, for example, India we use limited. UK terminology is PLC. It has 2 lakh share of par 2 pound 2 par value outstanding. When the CMC founder, who was also its research director and most successful inventor, retired unexpectedly to settle down in the South Pacific in late 2005, CMC was left suddenly and permanently with materially lower growth expectations and relatively few attractive new investment opportunities. Unfortunately, there was no way to replace the founder's contribution to the firm. First 6 line is just story building, and only relevant data for me is the company has 2 lakh shares outstanding, part 2, and they are standing late 2005. Once the founder goes, growth could be lower because I cannot write up my answer depending on the story. Then he says, previously CMC found it necessary to plow back most of its earning to finance growth, which averaged 12% per year. That means old growth he has given is 12% per year. Future growth at 5% rate is considered realistic. New growth would be 5%. That's before and after retirement data. But that level would call for an increase in the dividend payout. Actually, since shortage of a time, we did not discuss anything on the basic part of it, dividend policies and so on. 2 things are very important when you stay back in the company. Either company is giving you growth or company will give you the dividend. If company is not giving both, you leave. It's general tendency when you join the articleship, you know, and fresh article you become, not take it to the heart please, for educational purpose. The principles do not attach if they hear later on. Generally when a student joins the articleship, a new craze comes in. Someone asks stipend. Stipend is not important, work is important. Work. The moment they go, they realize work was not important, only stipend was important. Work remains the same thing. And think of a article who does not get work experience also, stipend also. That is exactly what company happens. You invest in a company, company does not pay dividend, neither give you the growth. So that's exactly company scenario which comes out. But that level would call for an increase in the dividend payout. Further, it now appears that new investment project would at least, sir, why he is focusing on dividend payout? Because if we are talking about Indian economy, we have a low payout economy because we are in a growth phase. If you go to the European American economies, they have a high payout economies. Any company which do not have a growth opportunities, they'll to satisfy the shareholders, they have to pay dividend. And why he is using this word is using this word because if the founder is going and if shareholders would leave, basically when shareholders leave, they'll sell off the shares and move. If they leave, the share price would take a hit. So the dividend payout has to increase, but he has not given what dividend payout would be there. Further, it now appears that new investment projects which with at least 14% rate of return required by the CMC shareholders, KE 14. Return from the shareholder point of view is cost from the company's point of view is KE. The is 14% would amount to pound 8 lakh for 2006 in comparison to a projected 20 lakh of net income. Let me do a full stop here and try to analyze. It says they wanted to invest in some project, pound 8 lakh. Projection of the earning of the next year is 20 lakh pound and return expectation KE is 14%. If the existing 20% payout were continued, existing 20% payout continue means the existing old payout is 20%, retained earning would be 16 lakhs in 2006. Even we know that because 20 lakh into 20% is 4 lakh, 16 lakh would be a retained earning. But as noted, investments that yield 14% cost of capital would amount only to 8 lakh. First paragraph in the line, he confuses so much. The relevant figures you have to pick. The objective of this question is any kind of a case study when it comes in exam. Do not get worried. The case study would have a simpler answer. You just have to pull up the numbers. From this, pick up as there are 2 lakh share outstanding. Par value was given the first line 2. Old growth was 12%. New growth, I think he has given 5. 8 lakh is the investment. 20 lakh is 2006 forecasted net income. And K is 14%. Again and again he is revolving around the same thing. That's only relevant data for me which comes out. Then he says the one encouraging thing is that high earnings from existing assets are expected to continue and net income of 20 lakh is still expected for 2006. That means before retirement was expectation of 20 lakh, after retirement also expectation is 20 lakh. Given the dramatical change circumstances, CMC board is reviewing the firm's dividend policy. So he has only asked exactly same way question would come. Then I am presuming he'll give you A. In A part 4 options, B part 4 options, C part 4 options, D part 4 options. That will come a case study. And that could be part of the MCQ. Exactly same pattern I think they have followed in the RTP which they would have given. Exactly same thing they'll give. Just since they had in the RTP of 2013-14 I think this question, there could be very high chance they'll repeat from this part here. A part he says is assuming the acceptable 2006 investment project will be financed entirely by earnings retained during the year. Calculate DPS in 2006 assuming CMC uses residual payment policy. Residual payment policy is whatever is left over pay as a dividend. So 20 lakh they will earn, expect to pay dividend of, expect to invest how much? 8 lakh. Balance left is 12. 12 lakh will be paid as a dividend. How many shareholders we have? 2 lakh. How much will come? 6. First answer would be a 6. First answer would come. Residual payment policy is, do not write anything. Answers we have on the slide. So not to copy, just focus on the wordings please. 20 lakh you earn, out of 20 lakh, 8 lakh you lose for investment. Residual is leftover, balance. Balance he'll pay as a dividend. That means whatever is left divided by 2 lakh would be a dividend per share. That's a. Another thing remember is since we are talking about 2006, 2006 is a forecasted year. That's a forecasted, so 6 would come. Second is what payout ratio does your answer to part A imply for 2006? The 20 lakh payout ratio is proportional to the earning paid as a dividend. You earn as 20 lakh, you pay as a 12 lakh. That means how much? 60%. So payout ratio is 60%. Answers are not tough. Third part. If the 60% payout ratio is adopted and maintained for the foreseeable future, what is your estimate of the present market price of the equity share? How does this compare with the market price that should have prevailed under the assumptions existing just before the news about founder's retirement? If the two values of PU are different, comment on why. Basically, C part is asking us calculate the price before retirement and price after retirement. Two things would have changed. Before retirement, your EPS was same. What was the payout ratio? Payout ratio he gave somewhere 20% payout. So D1 would be payout ratio would be 20% of the EPS, 2 rupees. Now after retirement is 6 rupees. KE under both circumstances is same, and G is what? G before retirement was 12, after is 5. So P0 will come different before and after, and the reason of different would be because the growth rate assumption have changed, and what has changed? Payout has changed. A student makes a mistake in this part is while calculating, you should know there are two formulas of calculating the D1. D1 can be either D0 into 1 plus G, that's one formula. Second D1 is EPS 1 into dividend payout ratio. We are using this formula to calculate the dividend. If you are using this formula, second formula to calculate dividend, and even if it changes growth plus and minus, do not recalculate D0 and then do it. So once again, if I have, let's suppose I calculate D1. If I calculate D1 as D0 into 1 plus G, every time growth will change, I'll change my D1. If my D1 depends on EPS 1 into dividend payout ratio, then I should not bother about anything. In some of the questions when you go back home, this doubt can come. If you do your regular questions, you will find if this changes, your D1 would change. In this question, you are not facing a problem because he has not given subsequent parts. Some questions will give you growth A, B and C. Even if the growth changes and your formula is based on this, then you just have to change payout ratio and calculate. If you have calculated D1 using this formula, then every time you will have to change the growth. In my particular question, the payout ratio he gave 60% after retirement, before retirement as 20. So my formula is based on this, I'll calculate accordingly. Same problem I'll show you in the valuation M&A chapter also. In one of the questions, I think this problem comes. Please remember this formula while calculating. So in this case, if I pick up what we have existing, So before retirement we have D1 is 2, I think will come, because EPS 1 is coming as 10, will be 2. And if EPS 1 is remaining same, sir, how did we calculate EPS 1? That was net income divided by shares outstanding. My D1 is equal to how much percentage? 60 percentage. 60 percentage would be 6, which comes out. Accordingly, I can calculate the price. Let me show you the answer first. Try to look. Number 12. Let me work out how we are doing the exam if the regular question comes. Slide number 7 I am on. Before retirement, after retirement, I've just put in the data that it says share outstanding 2 lakh, face value pound 2, before after, growth rate 12 and 5. This change came. KE is 14 and 14, investment is 8 lakh, net income is 2 lakh, 20 lakh, 20 lakh, dividend payout ratio this was given. This actually I have calculated or from the question I picked it up. So in box means it was not given in the question. Rest data was available in the question. This is part of a seva. So seva is bhavana. You do not have to write an exam. Residual payment policies means the pay all residual profits after taking care of investments. Then how much was the income you had? DPS of 6 we are calculating. 20 lakh income, investments 8 lakh, residual profit 12, 12 divided by share outstanding 6. And then I have dividend payout ratio means I have calculated EPS here. In fact, this is EPS is 20 lakh divided by share outstanding from the first line 10, and 6 you pay out of 10. How much proportion? 60 percentage you pay. The third part is share price before retirement. Share price before retirement is equal to, its EPS is 10, dividend payout ratio 20, D1 would be 2, D1 divided by K minus G, it's a perpetual growth formula, 100 pound it comes. Before retirement, after retirement is 10, 60% payout, and it comes 66.67. So basically I get answer first. Before retirement my share price comes out as 100, after retirement share price is 66.67. Two prices are different because payout ratios have changed and growth rate assumptions changed. These were the first 3 part answers. Fourth part I have not given you. You have to do. Fourth part answer I have not given you. Look at the fourth part and tell me the answer. Fourth part, tell me the answer. I'll show you once. Let me show you. I'll show you the question. Fourth part is this. Look at this. It says, what would happen to the price of the share if old 20% were continued? Assume that if this payout is maintained, the average rate of return on the retained earnings will fall to 7.5 and new growth rate will be. In fact, if I was setting this question, I would not have given you this G calculation. This G calculation is given. G is equal to 1 minus payout ratio is nothing but retention ratio. Retention ratio into R is nothing but G. It gives you G as 6. This says calculate the share price at 20% payout. Calculate that quickly. How much? 75. One we are getting. What were the old? We were getting 166 point. One answer I've got is 75. Basically saying growth will change, payout will be 20%, calculate the share price. If 20% is payout, how much D1? EPS will not change. D1 how much? 6 or 2. Dividend payout is 2 and growth is 6. KE remains same. How much price do we get? 25. The price has to fall because your payout is falling. So new share price, dividend payout is 20%, growth is 6%, and D1 is 2. In even dividend is falling and growth is not there, so price has to fall. Price will fall accordingly. Done. This can come as a MCQ. I'm saying the question was not tough. It was only the language of the comprehension passage was lengthy. There was another case study during this type of a case study which came, I think, Civil Corporation. Remind me at the end of the session. I think notes I have not taken. We'll try to see from the normal notes. We'll cover it up. For that, let me cover up some basic questions with you so that I can go to the two-step model. So flow should be there. Because recent trend, they have changed slightly of the way they ask the questions. Slight change has come in the pattern of the questions. Let me do first the conventional questions which used to come. This question which I am covering is not in your notes. It's a basic question. I'll cover from my notes only. Cover from my notes only so that you get flow of presentation. Get the flow of the presentation, then we'll cover from your notes. This is only in my case. You don't have this. This from the inter level I'm picking up. Question is the final only. Don't worry. The required rate of return for the investor is 15%. That's KE. ABC declared and paid a dividend of 4 per share. D0 expected to grow 20% for next 2 years and 10% thereafter. That's a different growth story we have. Compute the price at which share should sell today. A share should be selling today. Now, actually, what I have to do, since it's different growth model, I always have a habit of drawing in the line chart. In case you do not want to draw, it's okay. Basically, for 2 years, 1 and 2. 0 period I am standing, 1 year, 2 year. I'll calculate D1 and D2, and from 2 till infinite, growth becomes what? Constant. That means from second year till infinite, I'll calculate P2. P2 would be D3 divided by K minus G. Till the time growth is different, we'll calculate differently, and once it becomes constant, we'll calculate perpetual growth. Now D0 is given, so I can calculate D1, D2, P2, and then my 0 period value is nothing but discount back these numbers. That will be my share price. If I show you first the diagrammatical presentation, that you get adaptable, this actually gives me a clarity of how I should be writing my answer in the exam. Diagrams are not important, neither required in the exam. This gives me a visible clarity of doing the question. That means I was standing in D0. Since I was standing D0, growth was 20%, I calculate D1. Growth was 20%, I calculate D2. Then growth becomes constant from 2 till infinite, I calculate my perpetual value. It becomes P2. The discounting rate is the cost of equity, return expectation from the investor's point of view. That's 1 divided by KE was given as I think 15. 1 divided by 1.15. One more thing to remember, entire AFM, especially since you have a capital budgeting now, just on the calculator do 1 divided by 1.15. 1 divided by, and tell me 4 decimals, 4 decimal numbers. 0.869596. In exam, now should we use 3 decimal 4? Recent trend, institute has started giving the decimals. If they do not give by chance, round off to 3 decimals in the present value factor. Rounding off pattern would be, if it is 0.8696, it should be rounded off to 0.870. That means if last digit is 5 and above, round off to higher. Although I presume institute should give reward and marks, but the problem is happening at this place every time. Now no matter I go on, I criticize, I do not criticize, you cannot help it out. because number wise it's n number. You have the same exercise, if we do in the Excel, answer comes different. The problem is now institute has to give, specially when capital budgeting is there, they have to mention the digits. If they are not mentioning, let's follow the standard format. Three steps rounding off, three digit rounding off. Fourth digit is 5 and above, round off accordingly. Let's do once again. 1 divided by 1.15. First was 0.8696. Second number is 0.75. 7561. Since it is less than 5, round off to what? 0.756. Entire AFM follow this in the finals if decimals are not given. So I have rounded off accordingly. It's basically 0.870, 0.756 and 0.7. This helps me in understanding. Now that means for the purpose of my intrinsic value, whether I call intrinsic value, equilibrium price, fundamental price, that's one and the same thing. No change in that. That's called fair price in the zero period. As per me, what should be the value? That should be 104.33. So can I read this number? We can read this number. You should be able to read out mathematics actually. 104.33 means is, if I invest this amount today and company pays me one dividend as this, second dividend as this, and company I am able to sell my share at this, my in hand return would be 15%. Actually, some of you get doubt, why are we discounting by 15%? Same doubt you'll have in the capital budgeting also. Discounting rate is your earning rate, because whether I go forward or I come back, it should meaning same. If the 15% discounting rate justifies here, if I invest 104.33 today, earn at the rate of 15%, then in hand return would be 1, 2 and 3. I can reverse calculate also. 104.33 plus 15%, you receive this dividend, then plus 15% receive the dividend, the share price would come as this, rounding off. So this is the objective of 15% discounting. How do we present, sir, in the exam? Presentation of the exam, I would love if you can do this way, that this is the presentation of the exam. Look up please. Just keep in mind, I have some questions on this slide, so you'll get comfortable, don't worry. P0, today's price is nothing but summation of present value of dividends. It's a summation of present value of dividends plus present value of P2. Calculation of dividends is D1 calculation, D2, then P2 calculation. P0 is nothing but D1 into present value factor first year, P2 into present value factor second year, P2 into present value factor third year. Will be there, and you multiply accordingly, you get some numbers. It's 104.33. That way of reading also, I think I explained. Yes, I generally in regular classes I do that for you, just the understanding. Investor invest 104.33 today and grows dividend for 20%, 10% thereafter. In his hand return would be 15. Mathematically, let's not do it because I'll have to prove that something. So meaning of discounting rate is, if I invest something today, how much should I get the return, and whatever percentage return I'm expecting, that would be used as a discounting rate. 104.33. Second question I am showing you, I'll not show you the answer. I don't need any diagrammatical presentation from you. I just need how many years you'll calculate dividend, calculate the dividend, discount back and tell me the number. I think, let me see, 12th was 11th question. Just quickly do for me, since factors are given to you. It says on rough paper, since you have the papers, let's test the flow of the topic please. It says dividend will grow 12% per annum for 2 years. Rate is likely to be 10% for third and fourth year and will stabilize at 8. How many year dividend you will calculate? 4. D1, D2, D3, D4, and then you will calculate what? P4. What I need from you is D1, D2, D3, D4, P4, and then you have factors, discount back and calculate the intrinsic value. Last dividend was 1.5. Do it on the paper please. I'll show you the answer I have. Do it on the paper quickly. Then we'll move to something very interesting. For your dividend, D1, D2, D3, D4. Whatever answer you get, let me know. And if discounting factors are given to you, please do not presume your own discounting factors. How much do you get? 22 point. I have, this is my diagrammatical presentation. This is my diagrammatical presentation where I have D1, D2, D3, D4 and P4. And if I put on the numbers, D1 is coming 1.68. You can do even the rounding of 3 decimals. It's perfectly fine, please. Right, rounding off would come. So it's basically 1.68, 1.88, 2.07 and 2.28, and P4 is coming 30.74. If I put in this way, presentation from the exam point of view, we put this way. Its intrinsic value is equal to summation of present value of dividend plus P4. Then I calculate dividends. Intrinsic value would be equal to this, and my D1, D2, D3, D4, my interest. This was just to give you a basic hint of it, because the question what I am covering is not that straightforward what is here. Done? Those of you have done, next question after 12th in the notes is 18th. Read that question once. Those of you have done, read that question once please. 18th. So when you are reading 18th question, there is some technical problem which comes in that question. Before I do that reading with you, let me show you something else. This will become important part in some of the question when you work at home. Although answer comes even if I avoid this point. Look at this point please. What is the data, sir? Let me try to read out. In 2019, I have assumed EPS was 100, payout was 40. How much my dividend per share would come? 40. We're just trying to read out this data. Then what I did was, for 2020, I assumed a growth of 20% for EPS. How much it becomes? 120. Payout ratio 40. How much dividend will come? 48. Then from 20 to 21, I reduced the growth of the EPS. How much it become? 132. Payout ratio I changed to 50%. Just check the numbers. Does it come 66? Yes. Then from 21 to 22, again I kept this as 10%, and payout ratio same as 50. My dividend came 72.6. If you try to look at this data from 19 to 20, when the payout ratio was same, your growth of dividend and earning was same. Now the moment your payout ratio changes, the growth in the dividend changes. After 2020 to 22, again when the payout ratio remains the same and the growth happens here, whatever growth happens here, growth of dividend comes again same percentage. What does it mean, sir? It means is if the payout ratio does not change, the payout ratio does not change, growth in the dividends would be same as what? Growth in the earnings. The question what you are reading, in this question he might have given you dividend growth, but generally he might give you earning growth and says payout ratio will remain same. Till the time payout ratio remains same, growth in dividend would be same as growth in the earnings. If the payout ratio changes, then accordingly you have to shift your gear accordingly, because your formulas are based on dividend growth method and he might give you the data of the earnings. So this tells me if the payout ratio is same, growth in dividend and earning would be same. If the payout ratio changes, then or the growth changes, there would be difference in answer. Now why have I discussed this? Let me go back now to 18th question. Talking about is, let's read this question now. Let's read this question. He has given you Zumo and Company. This was RTP I think, and similar question has come in the exam also. Number 18. Wait. He says Zumo and Company is a watch manufacturing company and is all equity financed. Has paid up capital of 10 lakh. The other data related to the company is as follows. Year, EPS, dividend per share, share price. 2008 is the last historic year we are standing at. Then he says Zumo and Company hired one management consultant, Vidal Consultant, to analyze the future earnings and other related items for the forthcoming years. As per Vidal Consultant's report, look at the wordings. Earnings and dividend will grow at what rate? 25% for 2 years. That means I can calculate directly D1 or D2. Fine. Second point highlight. Earnings are likely at a rate of 10% from third year. Whereas when you apply dividend method, you need D. Earnings will grow at 10% from third year. Further, if there is reduction in earning growth, dividend payout ratio will increase to 50%. Dividend payout ratio will change 50%. I'll tell you where you make the mistake. Although roughly the answer might come same because of the minuteness, but correct way of doing is I can calculate D1 easily. I can calculate D2 easily. My D3 cannot be based on D2. I'm using my words very carefully, please. My D1 is based on D0. My D2 will be based on D1. My D3 will not be based on D2, because from second to third year he only says earning is growing, and when earning is growing, payout ratio is changing. What I'll do is I'll calculate E3. E3 will give me D3, and after third year, then since my payout ratio will freeze at 50%, since my earnings will grow at same as 10, I can assume even my dividend will grow at what? Same rate. I hope you are getting my point. This second point might look very ordinary to you. It's an area of a mistake which comes out. That means your earnings are growing and the model you are not using earning, you are using dividend. By chance in a flow, the answer might come. You say calculate the share price and P ratio from this. Now look at the way what I was telling you. Do not look at your screen. Look up once. What we say, I have clearly depicted on the line chart here. In 18, I have first year E and D both are growing. Second year E and D both are growing. I can directly grow. It's my D0. I can calculate D1 and I can calculate D2. After that, if you look at third year, this period is a problematic. In this, it is not growth of dividend. Growth of what? Earning. I calculate E3. Based on E3, payout ratio is what? 50. I calculate D3. If you try to analyze, this growth is not equal to 10%. Neither it is equal to 25%. Because D3 depends on E3. After third year till infinite, since my growth of the earning is constant, since my payout ratio will become constant, I'll say my growth of dividend will also be what? Same. I can apply P3. Look at this part, please. So when you are doing this in the valuation work, you will calculate D1, D0 plus 25%, D2 plus 25%, D3 will not be plus 25%. D3 depends on E3 and after that P3 and then you can calculate the here. Quickly look at the answer. Now do your calculation quickly. Do your calculation please. What we do is basically, if I show this complete slide, we calculate D1. D1 is D0 into 1 plus D. We calculate D2. D2 is D1 into 1 plus D. D3 would depend on E3 into payout ratio. Will depend on E3 into dividend payout ratio. And E3 would be equal to EPS3, that's E0 into 1.25 to the power 2, 25% for 2 years growth, and then 1.1, we get 10.656. D3 is nothing but, just check the calculations please. 10.651 into 50 percentage, it's 5.328. And then we have P3 is equal to D4 divided by K minus, that comes 73 point. And intrinsic value P0 is equal to numbers we have D1 into present value factor first year, D2 into present value factor second year. A general mistake is students calculate P2. P2 you cannot calculate please. It has to be P3 because growth has not become constant after second year. You are doing a dividend discount method, growth will become constant after third year. Third year dividend is not growing constantly. Roughly the answer might come same. Basically you calculate D1, D2, D3 and D3 depends on E3. You calculate D1, D2, constant growth becomes after third year because after third year payout ratio is constant and earning growth is constant. If the payout ratio is constant, the dividend will grow at same rate at which earnings will grow. If the dividend will grow at the same rate at which earnings will grow. And once you calculate your share price, then you can calculate your P ratio. The answer should be available to you, those who have the slides. 8th number slide. Done? D1, D2, D3. Similar type of a question, when you go back home, refer your notes, you will find in your material, lot of questions will be there. Same problem would be there. He'll say earnings is growing. He'll not say dividend is growing. He'll say earnings is growing. That would come. 18th. Now before I tell you to do 39th question, let me take up one question from, give me a second. Let me pick. So 39th I'll ask you to do on your own. These are the latest. At this question. This is from my book. I am showing you November 2020. First time was asked. After that, before that also once they asked it, and they keep changing it. Just do it. We'll do this first, and then I'll ask you to do 39th. Look up, please. You'll help me out with this part here. Look up. Slight changes in the languages in the last couple of years. This investor is considering purchase the equity shares of LX Limited, whose current market price is 112.30. Actual market price. The company is proposing a dividend of 4 for the next year. 4 for the next year. D1. Expected to grow at 20% per annum for the next 4 years. The growth will decline linearly to 16% per annum after the first 4 years. Linearly decline to 16. That means if this 20 and 4 years would be divided by 4, 1% every year. That will be 19, 18, 17 and 16. Thereafter it will stabilize at 16% per annum, and the investor requires a return of 20%. You are required to calculate the intrinsic value and whether it is worth to purchase the share or not. Purchase the share means you have to compare with the actual market price. Now diagrammatically, if I show you diagrammatically, look up please. First year is 20, second year is what? 20, third year is 20, fourth is 20. Linearly declining is what? 19, 18, 17 and then becomes what? Constant as 16. You can calculate D1 was already given 4 and then you can easily calculate 4, 4.8 so on, and you can calculate what? P0. That's fine. Your value comes, I'm just showing you the way of doing it because next question I want you to try on your own. So diagrammatically I have shown you it becomes 114.97 and actual market price was what? 112. You went to the market, as per you the value should be 114.97, available in the market at 112. That means it's cheaper available. We call it as undervalued or underpriced stock which comes out. This is the trend of the language. Now read question number 39 and try it from your side. Now read question number 39 please. If you look at 39th, I think paper setter was same because LX etc. the terms he used same. Investor is considering purchasing the equity shares of LX Limited, whose current market price is 150. The company is proposing a dividend of 6 for the next years. D1, 6 is available. LX is expected to grow at 18% per annum for the next 4 years. The growth will decline linearly to 14% per annum after first 4 years. 18 to 14, it will be 17, 16, 15 and then 14. Thereafter it will stabilize at 14%. The required rate is 18. By chance he has given 8th year factor, I don't think it is required. Intrinsic value we have to calculate. What we do is, if I try to put solution of diagrammatically, if we try to put 9, 9, do what? 1 year, here 5, 7, 1. D1 he has given me what? Growth he has given first year 18, 18, 18, then will decline. Interesting part is, if you want sir, I can take 14 from 7 to 8 and then constant, still the answer would come same. From the year when the growth becomes constant, Whether even if you want to calculate na 8th year, 9th year, 10th year, you feel some anxiety level, sir, no, I want to calculate for 15 years and then perpetual, still the answer would come same. Because whether you calculate perpetuity from wherever it becomes constant, or you keep calculating D8, D9, D10, D11, D12 and then perpetual, answer would be same. So 6, and then you can calculate for me D2, D3, 4, 5, 7. What I will do is 7th year it becomes perpetual. D8 would 6 plus 18 percentage. 7 point P8 7.08. Next 8.35. Next one 9 point. This is 8.35. Okay. Next 9.85. 86. Next one. Next one 13.38. Next one P8 would be equal to 15.39 to 1.14 divided by 0.18 minus P7. 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 How much do we get? 437 point. Since discounting factors are given in the book, use those discounting factors. Point 847, 0.718, 09, 0.51, calculate the entire value which comes. $172.598560. That should be perfectly fine. 172.856070. We'll mention about decimal zone. Approximately 172 point something. 172 point something. What was the actual market price? 150. As per you, value should be 172. It is whenever you feel a difference or problem of a overpriced, underpriced. Its simpler way to understand is, from the home when you go, your mother asked you to get 1 kg of tomato. Tomato is tomato. You ask her the price, she says 60 per kg. Went to the market and actual market price is 70. You know what you do? What you do with you start doing bargaining, because you know that as per the mother was author there, price is 60, it is overpriced. If by chance you get this as 50, you do not even bother about it, put it in, that's it. Now same way, when I go and buy the share from whom I went, as per me the price should be what? 172. Remember this entire AFM, because you have lot of underpricing, overpricing, whether this chapter, whether you go to the bond valuation, whether you go to some other portfolio somewhere, you will find these problems coming in. As per me, value should be 172.5. In fact, in forex and derivative also the same problem will come. 172.85. I went to the market and market is giving me the same item at what? 150. It is available cheaper. It is called underpriced. Underpriced is cheaper. That means it is available at cheaper price. Stock is underpriced. Stock is underpriced. Underpriced, undervalued, recommendation would be buy. Overpriced or overvalued, recommendation would be sell. Now similar question once more came, which was slightly lengthier in the nature, which is question number 4040. Similar question, but this was slightly lengthier in the nature. Read the question and slightly technical, well, not so straightforward what you have the recent one. Read the question once quickly. Question number 4040. Read out the question, make a framework, we'll do it together. This question, he has taken help of EPS. Based on that, he has done some calculations. So please. The current EPS of Messrs B Limited is 4. The company has shown extraordinary growth of 40% in the earnings in the last few years. High growth rate is likely to continue for the next 5 years. That means next 5 years will be 40% growth. After which growth rate in earnings will decline from 40 to 10% during the next 5 years. That means total period is 10 years. First 5 years will be 40, 40, 40, 40. Then 40 to 10, how much decline? Total decline is total 30. 30% decline in how many years? 5 years. Every year would be 5%, 6%. So it will be 40 minus 6, 34, 28, and accordingly you will manage it out. And then stable at 10%. The decline in the growth rate during the first 5 the decline in the growth rate during the 5-year transition period will be equal and linear. Even if it does not say, you have to assume linear only, even if this silent question is silent. Currently the company's payout ratio is 10%. That means how much proportion of the earning they are paying? 10. That means 10. It is likely to remain same for next 5 years. 10% will remain same for next 5 years till the time growth was 40. And from the beginning of the 6th year till the end of 10th year, payout will linearly increase and stabilize at 50%. So 10 to 50, how much percentage increase? 40. 40 increase in 5 years is 8%. So 6th year would be 10 plus 8, 18. 10 plus 8, 26, and so on. And the post-tax cost of capital is 17. PV factors are given to you. This is actually something good enough because we don't have the problem of the decimals at least. Now one thing they have to mention is rounding off should be done for the dividends in how many places. The moment they mention, you cannot have the changes in the answer also. You are required to calculate the company stock based on the expected dividend. If the current market price is actual market price. Suggest if it is advisable for the investor to invest in the company stock or not. If you look at now data, please let's try to analyze growth rate in earnings and EPS. Growth in earning is 40, 40, 40 he gave us. Then from here basically decline comes, or how? It's total decline was 30 percentage divided by 5 years. Every year is 6% decline. 34, 28, 22, and this. The payout ratio, if you multiply this, these are the payout ratio for the first 5 years, and then payout ratio increases. This into 18 comes out, and then he has done some calculation. And once you do the dividend calculation, present value factor are there, then you can calculate the intrinsic value. Since intrinsic value comes 118 and actual market price was 125, it's a costly, not advisable to invest in the same, it's overvalued. Quickly check. The only problem creation data is this data point. Check the calculations. This question should not come less than 10 marks but I think they gave 8 marks or so. Those calculations were lengthy and the rest was straightforward dividend. Look at the data please. 39 question, why not considering? It's in after 4 years it will stabilize at 14 percentage. Time period I'm not given that. Basically we get the hint from here, its time period is equally in actually specifically in this case it was specific 5-year period. That basically linearly would mean is the 1% every year which comes. The correct way should have been he should mention the how many years. The first question which I showed you from the book showed you how many years. Same problem. That basically what he's asking is, can we assume from 18 can we stabilize directly 2%? 18 linearly actually is 1% only. Linearly is equally. It's equally here, so assumption is 1 year every year here. 1% every. This question was clear cut. It said basically clear cut indication that in how many years it has to become equal. In how many years? These also give the hint. This also gives the hint. This indirectly gives the hint how many years data we are calculating. Please check the answer, please. Once you've done, read question number 42, a very interesting question. Not appeared in the exam till now. Was in RTP long time back. (42) This was a part of RTP, I think 2018 somewhere. Let me read out question with you. It says Sam Limited had just paid a dividend of 2 per share. Just paid is D0. Expected to grow at 6% per annum. After paying dividend, the board declared to take up the project by retaining the next 3 annual dividends. Now they don't want to pay any dividend for the next 3 years. It is expected that this project is of same risk as the existing projects. It means cost will remain same, KE. The results of this project will start coming from 4th year onwards from now. The dividend will then be 2.5 per share. Dividend will be then 2.5 per share and will grow at what? 7% per annum. An investor has 1000 shares in Sam Limited and wants to receive at least of 2000 per annum from this investment. Actually, this question should be, frankly speaking, part of something called homemade dividends, which used to be there as a part of dividends chapter old course. Old to old, I should say, rather old to old, the homemade dividends. Now it is not a concept there, but somehow the question they have given and prima facie you cannot make it out. Homemade dividends is, for example, I am holding 1000 shares of ITC. ITC every year declared, let's suppose, 7 rupees as a dividend. So I get 7000 in hand, and due to some reason 1 year ITC is not able to declare a dividend. Now I am habitual of a 7000 receipt. What should I do? In that case, I sell off my share and take care of the 7000. That's called homemade dividends. I was getting 7 rupees on 1000 shares every year, 7000 rupees were coming. Now the ITC has not declared for a particular year any dividend due to some expansion project, and since I want to fulfill that receipt, how do I fulfill that receipt? Is by selling off the shares. That's homemade dividend. He has not used that name. Basically says investor has 1000 shares in Sam Limited and wants a receipt of at least 2000 per annum from this investment. Evaluate whether the market value of the share is affected by the decision of the board. First of all, he says if the company, basically he wants us to calculate is the calculation of the share price if normal dividend is paid every year, what they have been doing, and if expansion is done and dividend is paid in the 4th year. So let's verbally check it out. If the dividend is paid regularly, let's suppose if dividend is paid regularly, I am standing, let's suppose here 0 period and infinite. What is the growth? 6. What is D0? How much D0 they have given? 2. My price would be equal to, formula would be D1 divided by minus G. How much do we get? 2 into 1.06 divided by, so he has given the cost of capital in the second point, I think 8%, na? 0.08 minus what? How much do we get? 106. If expansion is done, then what will happen? I'll directly get D4. He said 2.5 dividend will come in which year? 4th year. D4. How much? 2.5. But the growth will increase to what? 7%. So using D4 and 7% growth, I can calculate what? P3. 2.5 divided by rate minus 0.07. How much do we get? 250. This is, if I time period stand, I am standing where? 3rd year. Come back to 0. Come back to 0 because you are standing at the 3rd year end. You will have to come back to 0. 1 divided by 1.08, 3rd year factor 0.794, 198, 8.45. So basically what we say, if the company pays regular dividend as it is, the share price would be 106, and if the company goes for expansion, then value will become, in present value term, 198.45. So basically it's advisable to go for expansion. If I show you the answer, look at this part please, 11th slide number I am on. It was part of RTP 18 years. Calculation of a share price if dividend is paid regularly when no expansion is done. If no expansion is done, we say it's a 106 price. If expansion is done, then no dividend will be paid for the first 3 years. If no dividend is paid for the first 3 years, then I can have D4 2.5 I'll get P3 as 250. To bring back P3 to P0, I'll get 198.46. He asked me a question that would the value change? The market value of the share is affected by the decision of the board if it decide to reinvest dividend for the next 3 years. The share price increases from 1046 to 198.46. In the second part, this just I have shown, maybe examiner might add one point. What is the impact on the wealth of the shareholder? What is the impact on the wealth of the shareholder? Actually, you will be surprised. I don't know it's appropriate time to cover this or not when a company takes, because let me just, whether that news is publicly out or not, then I'll show you the impact on share price. How the this planning, what they do now. Let me get that confirmation. I'll show you something else. Trying to check the impact of one news roaming around on the company, that when a company announces some project, the project is just announced, nothing happens, but anticipation, the price starts moving. When the price starts moving in, they basically, what they do is, the what you see here, actually this is impact of the project which comes out. They have taken some numbers. In practical life, it is not even the numbers. If let's suppose some company announces a project that this is the project we are getting, then you have done so much of a capital budgeting, you do not realize what you do in the capital budgeting. When you calculate NPV, what does that NPV does? That net present value calculation, nothing but you stand in zero period. The markets are so matured that they do the projection from that project, calculate the net present value. Whatever that net present value comes in, that's actually a wealth maximizer. And whatever that increase comes, they divide by number of shares, and whatever increase comes, that actually represents kind of increase in the share price. So wealth maximization concept is represented by NPV. There are a lot of companies in India which are moving due to some announcements, maybe in the pharma side, maybe in the telecom side, maybe some other. So I'm not naming any one of them. I was trying to find some news. If that was available on the net, I would have shown you. Since that was not available, I'll not show you, because it could be a rumor also. Any discussion I do in the class, again I'm saying it's only for education purpose. I do not have any attachment with any share price relevant to buying selling advice. Show the impact on the wealth of the shareholders if the company has 10 lakh shares. Now if actually this project goes through and this kind of an increase comes, it means wealth of the shareholder will increase to 924.6 lakh. This could be the additional point he might ask you. Similarly, since you'll be doing a capital budgeting, you should know what you used to calculate. NPV was also same thing, approximate. Net present value is any company announcing a project, any company announcing. I think one company I can take which is publicly available, but I don't know whether that is the impact or not. Only for education purpose I am taking. I'll just show you something. Look at this. For example, look at this company. India's one of the, I think, telecom optic fiber companies. HSCL enters into Europe with 144 crore optical fiber line. I was trying to find out whether this is showing. Look at this. The third line. HFCL share hits 52-week high after establishing facility in. Now I have to click here. Read further. Facility in Poland. You know what is the meaning of it? Actually, I expect from you that since we are in a extreme fast track mode, marathon revision, what you call it as, I do not have the liberty to discuss these items. General classes I discuss only for educational purpose which has relevance with my subject. You should know at a final level what does that news mean and how do I attach with my subject. Now this is actually, they have announced a facility in Poland, means maybe they are established some plant. Now what you do in capital budgeting, exactly same thing they would have done, and market would have assumed that they will get positive income from them. Maybe how does market behave? We do not have to calculate. They would have done some calculation, recalculated present value, and accordingly share price increased. Technically, if I speak, that increase in share price may be the NPV calculation if I do in my financial world. Now, how does a project? Exactly same thing this SAM question is doing. The share traded 3% up to 115 to 52-week high in afternoon trade on Feb 21. After the company announced strategic expansion into Europe by establishing optical fiber cable manufacturing facility in Poland. What you do in accountancy is, when the things will take place, you will record. What is the financial management is, with the anticipation, they do some their own calculation. Now, for example, practically what will happen? Let's suppose they establish practically. I don't want to see my credit score. I don't know. Now, for example, practically what will happen is, let's suppose project is started and there is some problem in the project, or there could be some problem which came out, revenue did not turn up. That's a secondary item. After 1, 2, 3 years, we'll come to know. But market is in some rejoice mood. With the announcement, if they think this will help the company, the price will shoot up. If they think this will not help the company, price will fall down. Exactly same thing we were covering. So I was just trying to show you that with the news items, for example, the SAM like a company, these are not the examiner is just creating a question for the sake of creating. He would have heard this somewhere and he would have known company wanted to go for expansion. Instead of saying that directly or taking a name of a company, he projected in the question and he said, if the company is planning a projection plant, then what is the expectation? Exactly same thing is happening here. Since your course is involving only a dividend policy, he has taken in the dividend front. Same can be replicated with the free cash flows. At what I showed you with the HFCL, those analysts, the people who cover those companies are called analysts. They make cumbersome Excel models. In that Excel model, they'll do some projection. Company will give them some guidance that these are our planning, and accordingly they'll rebuild the model. And maybe if they think positive, they'll publish a positive report and market anticipates accordingly. So these are just the idea that what you are studying is not just for the sake of studying. Your entire subject can be linked with the market day in, day out. Entire subject. We'll do some right issue, and when I was coming today for the class, I thought was seeing one of my cousins were holding one of the company's share. They've issued right issue. The last 2-3 years, so many right issues have come. It's unbelievable. So I'm 90% sure if any examiner is doing a practical side of the market, he'll set the paper on the right issue. Because every then and there right issue is there. I don't know how many of you track the equity markets or not. At final, I still assume this is not the right time to discuss these things. But I still assume you should be in your life. CA you will become, I know, maybe a gap of 6 months, 1 year, it's okay. But if you have not updated what is happening in the market, it's of no use. You should know what is happening, what is the trend in the market, and especially equity markets when you will be the CFOs of company after 5-10 years of your work experience. Because after 10 years of your work experience, you have to become a CFO. And the way the IPOs are coming in India, I cannot imagine what is happening. Means this will become with the top 3 very soon. It has to come, the Indian economy. IPOs are coming back to back, and you should know that at CFO level only CA can become. At every CFO, CA is there. You should be knowing what is happening, what are the ways of raising money, how the valuation are increasing, because our P multiples are increasing. When I use a word P multiple increasing, means we were not commanding a good valuation earlier days. Now we are getting a good commanding position. The SME IPOs are coming in. The companies are doing expansion. Government is helping them out. So you should be knowing that when they talk about the wealth creation, this is one of the parts of the wealth creation which comes. Also, this was a point of view from the discussion I was talking to you, that if we are speak about any country, especially like India, this question for, let's say, speak out, they'll not pay any dividend. General tendencies, if the company is not paying dividend, the company is not good. India, we have other way around. If you go back and check the history of the Microsoft also, I think they did not pay dividend for around 15-16 years, I think. The moment they paid a dividend, share price started falling, because the investors started presuming that they might not have a growth opportunity. This question exactly reflects. For the purpose of exam, yes, we finished it 5 minutes back. but for the educational purpose, you should know attachment of it. My expectation is, I'm taking 1 minute single nalike. My only expectation from you is whether you're writing exam, whether you're attending revision class, whether or not, at least half an hour, open up any newspaper of your choice and 2 pages of business section to know what is happening around India. India has to become its China plus, means when we talk of China plus one, that means that could be a replicable story we have, and you have to be part of that story. If you do not know what is happening, which sectors are growing and why are they growing, I was taking a budget speech, I was talking to them, the next 6 months would be so critical. You will find some sunrise sectors which you cannot imagine. The history was something else and the future will be something else. The moment you go into the world and you show your CA degree, everyone would show the CA degree. What is the differentiating factor you have and they have? I'm not asking you invest in the market, take a call in the market, nothing else. Derivative is part of my chapter, but I never advise to do FNO. You'll destroy everything the moment you'll start doing future option. In questions you'll find, when we'll do the governor questions, you'll find, oh, so much money we can make. But at the end of the day, 90% people lose money. The SEBI guideline also have started coming, I think. If you open up a demat account, that comes in. Knowing one part is important, but you cannot be blindfolded. If you are not part of the equity markets, knowingly, unknowingly, we are missing out something. Not from the point of view of earning. It's from the point of view of because you'll be taking some decisions for a company. Should we take a decision? Where should we open it up? What is happening? Any sector of your choice, pick it up. And some new sectors will come. Soon after exam, budget would be there. Do not miss out that budget. I think that would be historic budget. If I would have read the previous budget and assuming the stable government comes back. The stable government, I'm not talking any government. I do not love any government. Governments are only for my educational purpose. Because my market get fixes. No, like, do not get emotional, sir. Come back. No. Market is emotional. Let's come back. Actually, I don't know why I feel that though you are doing CA, but this course is tough. This course is cumbersome in the numbers. With that, you have to develop your reading skills. If you are not developing, you're missing out something. 100% you're missing out. Articleship is something which is training you, that's fine. But you should be adapted to what is financial world talking about. We are getting such a respect we never used to get from the equity market. I know since I tracked that. We never used to get. If the foreign investor used to leave India, everything used to be destruction mode. In the last 2-3 years, I don't know what has happened. Foreigners are going, let them go. It's okay. No matter. And I am presuming when they'll come back, this time retailers will be having a upper hand, which will be there. But anyhow, be careful. We are standing at a very overvalued scenario. This wealth creation was one point which will add from my side. Second part was the important, which was the reason of discussing this question. All discussion for the market would be educational only. Second part, which was there, recommend how the investor can maintain his target receipt. A very, very important part, please. This is actually a homemade dividend. I'm presuming should not have been given, but 99% sure this will come back because no one knows whether this topic relates to what topic. This was a homemade dividend, which is not there in the security valuation, I think. Recommend how the investor can maintain his receipt from the investment for the first 3 years and improved income thereafter, given the cost of capital of the firm is 8%. Now, what does he want to say is, as of now, we were standing, you were getting how much dividend? 2 rupees dividend. How many shares he has? 1000. That means he'll get how many shares? Dividend of 2000. If company is regularly paying dividend, then every year dividend will grow at the rate of, I think, 6%. Na? 6. So he'll keep getting 2000 rupees in hand. He does not have a challenge. If the company goes for expansion, then 3 years dividend will not be there. The question is very clear. He says you have to advise him either he should have 2000 or more in hand so that he can satisfy himself. Basically, the language says, how can he get a target receipt that's at least 2000 in the hand, which he can get. Now, second part would be, when we look at the second part answer, if company is not going for expansion, 2 parts I have divided. If the company, investor position, if the dividend is paid and no reinvestment is done, that means expansion is not happening. D0 was 2. Today dividend he got 2000. D1 would be 2.12, he'll get 2120. D2 will be 2.25, he'll get 2250. D3 would be 2.38, he'll get 2380. So that means basically his expectation of 2000 would be met. Is it fine? Nothing will happen. Before I read further, since we have not covered basics of this, let me do one thing. Small data point I am putting here. Do not read the second part answer, please. You make investment in a property in 0 period of 10 lakh rupees. Your return expectation, investor expectation is 12%. You expect that price to become what? You expect a 12% return. Investment was 10 lakh. 11.20 lakh plus 12%. Now suppose during the year you received a rental income of 40,000. Rental income 40. Your return expectation was 12%. If no rental income comes, you expect the value to go up to what? 11.2. That's basically plus 12%. If you receive 40,000, then even if this value becomes, I think, 10.8, still you would be satisfied of a 12% return. That's actually practical life when you do any investment. Now when you say KE, KE is called cost of equity from the company's point of view, return from the investor's point of view. If KE is 15%, you should be able to read out this number. Investor is expecting a 15% return from the company. Return can be form of a capital appreciation, return can be in the form of a dividend. Means he has to get 15% return. If company is paying 5% in the form of dividend, he'll expect the capital appreciation to be 10. In case company is not paying any dividend, then capital appreciation would be 15%. Now in this case, when we are looking at the SAM question, if reinvestment is done, case 2, that means there will be no dividend. There will be no dividend. Then I have dictated, if you want to avoid this line, it's up to you. You can directly show the answer the way your institute has given. I have dictated it clearly that exactly what is happening if dividend is not paid. In this case, investor will have to sell the shares so that he can maintain his consumption. My problem is not selling a share. My problem is he'll sell after 1 year, 2 year and 3 year. What price should he sell? In this case, the investor will have to sell the share to maintain his consumption level of 2000. The expectation of investor is 8% from the company. KE was 8, I think, in this question. Since the company is not expected to pay any dividend for the next 3 years, company is not expected to pay any dividend, hence the investor would expect the return of 8% in the form of capital appreciation. That means he'll expect my return of 8%. If you're not giving me any dividend, you should give me price appreciation. That means if I stand at 0 period, my P1 would be P0 into 1.08, that's 214.38. P2 would be again 1.08, 231.49. P3 would be again 1.08, 250. That means if no dividend is coming and return of 8% was expectation, that means price of the company should increase by 8%. And number of share to be sold would be, I need 2000 divided by first year price 214.34, 9.33. I'll sell 10 shares. Because if I sell 9 shares, my 2000 rupees will not come in hand. He want minimum of 2, over and above is okay. So we'll sell off 10 shares. Second year 2000 and price would be 231.49. He'll sell off 9 shares. This is called homemade dividend. 2000 and then price is what? 250. Sell off 8 shares. That means number of share at the end of 3 years will remain is 973. Although he did not ask, if you want to write, you can write. Otherwise your question should end at 10 shares sold, 9 shares and 8 shares. This question also, please mark it important from the perspective that KE means what? It's a capital appreciation if dividend is not there. When you go back home, in your books you will have one question called DSC limited, I think. There would be wherever you've taken the classes or if you have studied from me, will be question DSC. In that exactly same point would be there. If company is not declaring any dividend, then what would be the question? I'll just show you. That is question number, I think. Give me a second time. You'll get the hint. A very, very important question. I have not covered in this session here. That also has this is DSC with digital electronics. This question will have exactly similar type of a problem. This question also has not come in the exam. Since I'm covering in one, I did not cover it here. When you go back home, any book you are referring, question would be there. You refer this out and you'll find out that he'll ask in the second point, what do you expect to happen to the price of the firm? So accordingly, manage that out, please. What we are covering in this part is, if the company is not declaring any kind of a dividend, then the capital appreciation should happen at the rate of a KE. And prices is indirectly ask you P1, P2, P3 and the number of shares. Quickly look at the question. I am assuming important because it has not come for a long time, especially being part of the course. Read it out. I'll move to the next part then. When you go back home, do revise the same questions again. Now, next part I'm moving into, which is happening in the markets and how the questions are being framed on that. One is buyback, which is very common now. Second is right issue. Buyback is simpler, so you'll understand, don't worry. Still, let me formally cover one example with you, because buyback is also one of the very important parts. It's a form of a dividend. Actually, buyback was not a security valuation. The buyback was a form of a dividend chapter. Dividend is nothing but how the company will return back the amount to the shareholders. So still, that's old phenomena. They are covering it institute, assuming that buyback is part of the security valuation. Buyback remains part of the course. Question number 22 I am covering. Verbally we'll cover it up. It's easier part. Just brush up. Do not leave this part. Buyback. Abhishek Limited had surplus cash of 90 lakhs and wants to distribute 30% of it to the shareholders. The company decides to buy back shares. The finance manager of the company estimates that its share price after repurchase is likely to be 10% above the buyback price. That means whatever is the buyback price, after the buyback the price will become 1.1x if the buyback route is taken. The number of share outstanding at present is 10 lakh and the current EPS is 3. Determine the price at which shares can be repurchased if the market capitalization of the company should be 200 lakh after buyback. Now, you know what is the market cap formula. Basically, he wants to know market cap is equal to share outstanding into share price. Share outstanding into share price. Now, 90 lakh rupees, how much amount he want to distribute? Amount available for distribution would be 90 into 30. How much amount? 27 lakh. If I want to calculate how many shares he'll buy back, let's suppose buyback price is equal to X. The number of shares he'll buy back is equal to what? 27 divided by X. That comes out. And the share outstanding after buyback would be, the share outstanding before buyback are what? 10 lakh. 10 minus 27 divided by X. These are share outstanding. And price after buyback is what? 1. 1.1x, and he is assuming market cap as what? 100. So the share outstanding after buyback into 1.1x would be equal to what? 100. We have to solve this. If I quickly look at the answer, he would have done, actually he has done very shortcut way. He has done the P price, I've assumed x. Basically it is 1.1x into the share outstanding are 10 lakh. The buyback would be done for 27 lakh divided by x should be equal to 200 lakh. Market cap formula is share price after buyback into share outstanding after buyback. Solve this equation and get the price. I think you'll get the same number. 1.1x 10x minus, solve for x, solve for x. Exactly same thing since answer was given, so I have done rough way here. How much do we get? 20.88. Second ask point is number of shares that can be repurchased. How much amount you have? 27 lakh divided by what? 1.29 lakhs, or you can put the entire figure. And then he is asking impact on the EPS. Earnings will not change, but EPS would change. Earnings would not change, EPS would change. So old EPS was 3, old share were 10 lakh. So earnings, if I ask you, earnings is equal to what? 30 lakh. And new shares outstanding would be 10 lakh minus 1 point. How much do we get? 3.44. This is the straightforward question what he's asking in the exam. This you could have done, I know. The second variety of a question which he started asking is the reverse calculation. Look at the 37. Look at the 37th. Try on your own once. 37th question. Try doing the numbers on your own, please. Done. It says Eager has a market capitalization of 1500 crores. Market cap is nothing but the share price into share outstanding, equity number of equity shares. Current market price is 1500. You can find number of shares would be 1 crore. It made a PAT of 200 crores profit, and board is considering a proposal to buy back 20% of the shares at a premium of 10% to the current market price. So the number of shares to bought back is 20 and the buyback price will be 1650. So 20 lakh shares you are buying at 15, that means 330 crores. It plans to fund this through a 16% bank loan. You are required to calculate the post buyback earning per share, EPS. The company's corporate tax rate is 30%. Company's corporate tax rate. So basically nothing is done. Actually, what would be done is, amount of a loan is there. Once you take a loan, what will come in the income statement? Interest. So I think he would have done same thing. If you can help me out, how much was your PAT level? 200 na? If this is, let's suppose PAT, I'm assuming, and then you would have tax, then you would have PT, then would be interest, and then comes what? EBIT. EBITDA we have not reached yet, that will come soon, don't worry. EBIT. This is 200 after how much tax? 30% tax. So my EBT would be 200 divided by 0.7, how much? 285.714. There was no interest earlier. That means your EBIT was also what? 71. In the new structure, what will happen? This will be 285.71. Loan amount of how much? 330 into 16 percentage. 2.80. This will be my new EBT now. 232.914. Tax at the rate 30. How much? 9.87. PAT would be 163.04. And he asked us to calculate what? EPS, no? Divide by what? I think 80 lakh. So if you divide by 80 lakh, this is crores above number. Crore. EPS would come 203.8. I think recently he asked one more reverse type. Let me test you on that. Not part of the book. Let me test you on that. Calculate for me. First buyback. Try out this cleaning up for you. This was similar to May 23, slight different in the numbers and maybe 1-2 part here and there. It's a reverse calculation now. First you try out, then I'll do it with you. Market cap 3000 crores, current EPS 100, P ratio of 15, 20% of the shares at a premium which can be supported financial. Try out once. I'll just give you the basic hint. You need to calculate EBI interest. If you are able to calculate PBD of both the levels, basically what will happen post by, I just go back to the previous question and think logically what was the objective. EBIT was same, difference was EBT because interest came. That means using this data, what is here, if you are able to calculate the two EBTs, the difference would be nothing but interest. So once again, go back to the previous question and see what you did was you reverse calculate EBIT, and then in one case interest came, second case interest was not there. That was straightforward. Now I'm saying calculate both EBT. No matter how you use this data, calculate EBT. EBT would be different, EBIT would be same. EBT would be different because in one case there is no interest, second case there is interest, and once you get interest 8% rate, you know you can calculate everything which comes. I've given you the hint. So you do direct, indirect, means whatever you do, your feeling should be understood by the paper checker. Bhavana has to be expressed, no matter how you express. But if the second person is not able to catch, then it's waste of a time. Actually, paper checker would only be interested in that number. How do you calculate it irrespective? That number is important. Let me give you a hint. If using this data, you can calculate earning after tax in both scenarios. First, you calculate earning after tax in this data in both these scenarios. Done? Since someone has done, so done. Once you do, let me know. What is your answer, Tamil? How much loan amount? 660 crore is the loan amount. And how much is the premium answer? Share price premium percentage for the current market price? ₹660 crore. That's the interest. 52.8 is the interest we are getting. Since n number of answers we are getting on the same front, let us work out the way they work. I'll give you one more minute. Try out once. Two parts are there. This is actually third part, I think. Important part is post payback P ratio will remain same. This will also be the backbone of the valuation chapter. P ratio will remain same. Here is giving a hint. You can calculate EPS and calculate something. Let me work out. Market cap 3000 crore, earning per share 200. Price earning ratio 15. Using old data I am doing. Old P ratio into EPS will give me market price. How much do we get? 3000 market price. If I get 3000 rupees market price, this is this number. That means I can calculate outstanding shares. 3000 crores divided by market price. I get how many shares? 1 crore. Buyback, he said how many shares? 20%. So buyback shares is equal to 20 lakh. Remaining share is 80. One data I have got, existing share are 1 crore. After that is 80 lakh. So let us do one thing. Let's first talk about the historic earning. Historic earning would be, sir, 200 EPS, 1 crore share. Earning after tax or PAT level, how much? 200 crores. And if I ask you EBT level, tax was how much? 30. EBT level would be? Divide by 0.7. 200 divided by 0.7, na? 280.71. This comes out, one part is done. Now let us talk about the second part. He says the expect post buyback price is what? 3057. Can I do something from here? If I know my P ratio formula is what? Price by EPS. He said P ratio will remain same. Price earning ratio is how much? How much? 5015. Price is 3057. EPS I have to calculate. This is new. This is new. I am working on. So my new EPS comes out as 20.8. How many shares outstanding? 5. That means in new, can I calculate now? My PAT would be equal to 163.04. This will be equal to 232.91. If you want to go further, you can go, or directly difference of these two is nothing but interest only. Difference is interest. That interest came, I think, 52 point something, you said 52.8. Divide by 8%, you'll get what? 660. That's how it is. If you look at exactly same thing, 3000, 1 crore, 20 lakhs I have, post buyback price, the new EPS, the new earning after tax, that's new only, and I can say pre-tax earning before buyback was 230, 20, it's a lakh even, you calculated in the crores, it's fine, 232.914. Earning before buyback 285.71 something, and difference of these two 52.8 crores, mine is in lakh, 660 crores. The price, buyback price would be 3,310%. In 23 question, I think there was some ambiguity in the language form, so I have not taken that exactly. This was the correct language which was. This is reverse calculation. Is that fine? Now let's go back to the rights issue, which is a very common in the present scenario. Rights issue. A very common. Couple of right issue are open now only when we are talking, and some has finished yesterday also. We are talking about rights issue. And one interesting part has started coming in the right issue. The right issue, earlier they were asking the full money at one time. Now they are asking a partly paid shares also listed. Means this trend I am seeing for the first time after a long time. If you would have asked me 3 years back, I would have said, I don't know why the concept of partly paid share comes, etc. But post COVID, after the Reliance partly paid, means n number of partly paid shares have come. So I think India Bull Housing Finance will list tomorrow partly paid. Just finished off. And today I think, because why I am saying, if any examiner is following a trend, then he'll set the paper on this kind of a topic which comes out. Right issue has again emerged. Look at this. Can you see the eyeball second one? This is India Bull Housing Finance. That's normal. That's the name of a company. Right issue. Just think listing will happen has happened today or will happen tomorrow. Nothing is coming as of now. No? When you open the screen tomorrow, BSU go RE. It's suspended to proceeding. Don't worry anything. This will come up. Don't worry. So this is rights issue. Na? Huh. Here rights have been allotted actually. Rights have been allotted. This happens trading, and tomorrow I'll have a third screen also here. I think partly paid. For example, let me show which has happened. You should know what is the meaning of these things. Can you see this? Now in Suzlon, you look at this three part here. First is Suzlon Energy. That's a normal share. Then is Suzlon Energy RE. Rights came. Rights trade in the market. You have the option. Either you, for example, I have the Suzlon share. Let's suppose rights came to me. Later comes in. If I apply, it's okay. I can sell right, or if I forget, that becomes zero. And those who would have missed the rights issue of Suzlon, I think they would not have slept for 3-4 months or 6 months. Anyone know why? It came at 5 rupees, and when I was taking the regular batch, during that batch itself it became 40 rupees. Means it was a nightmare. Let me show you this only. Third is PP, partly paid. Partly paid, once you pay the entire call, you would have done call money comes, they also stop trading. Now if you look at partly paid, it will show you suspended due to procedural reasons. It is not suspended, it's actually when you pay the full money, they become what? Fully paid, and they become part of what? Let me show you the price itself. One of the major, and this is a story of a restructuring if you do internal reconstruction in accountancy. Look at the high low. 6.96, 2-week low, 3.75. Right issue came at what rupees? Corporate action. Right issue 2 times 22, it came 5, go back home. How do you know 5? Anyone applied? No. Very good. You should focus on the CA finals. This is like useless things. So just go back and check Suzlon, because actually you should also, why I was telling you as a CA, I'll take one more emotional point has come. Part of the course anyhow. You should also do it. You do so much internal reconstruction. I don't know whether you spend time or not. Maybe you make the account, land and building revalued, profit and loss, write-off, etc. To ask yourself question what exactly you're doing. Go back and check Suzlon. Go back and check the conversion of some amount of the idea to the government interest. That was also kind of a restructuring. Go back and check maybe JP Associates. Go back and check the restructuring of the companies which has happened. Some of the companies. I'm not saying go back and invest. HCC, for example. You go back and check, did restructuring happen in them, and does it happen the same way you do it, and then check the movement in the prices which has come. Means as an accountant, I'm saying you are so knowledgeable, but somehow you do not even see that what we are doing is actually we are replicating in the practical side or not. These all companies have underwent restructuring. All companies. And once you clean up the balance sheet, and if the business model is good, then who stops them? Suzlon was, I think, no one, when the right issue came, 5 rupees, the share price was 6 or 7 rupees. No one wanted to touch it. Now every third day news on the Suzlon comes. It's not advised to invest, please. Now it is already market value has increased. Especially HCC also. Go back and read at least for your knowledge purpose. Read this company. What was the work of this company 10 years back? What happened to this company? How it went to the problem? Did something happen? I don't have the liberty of the time, else I would have shown you some news item. That means when you read, you come to know if something is re-emerging, and then what is happening. Same is, I think, maybe with the JP Associates or some of the JP companies or some of the companies which one? I don't know whether, I'm just telling you a few names. Means when you are in the market, you come to know this exactly go through the same accounting process. My objective was actually not this. My objective was the rights issue. So I will, for example, now this I'll be able to show you tomorrow very clearly. India Bull Housing Finance, as of now, 2 you see, na? Tomorrow remind me any one of you. I'll show you 3 would come. I think tomorrow partly paid would list. They issued the right issue at 150. The price in the market is India Bull is approximately 188. So price that automatically gets adjusted, that is not worrisome. The problem is when the rights were issued, they reflect in your demat account. When you apply, the shares will come as a partly paid. If you were supposed to pay fully paid, in your exam which question comes are fully paid only. So you get the right, things would come to you. If you ignore right or if you do not sell right, you will be at loss. That's the main thing. Otherwise, because the price gets adjusted, it's same as, let's suppose I'm having a 150 rupees 2 item and third item is saying you buy 2 item 150, third you'll buy at 100. If you do not buy at 100, you are at loss. Otherwise, your 152 into 2 plus 100 into 1, your average cost will come down. That is the objective of the rights issue. So this tomorrow, remind me, I'll show you. I think that listing will happen tomorrow. Yes, listing will happen tomorrow. Suzlon was one of the game changers when it happens, and now since we are moving into clean green energy, the objective of the budget also I think should be the biggest day in your life. If you miss out, that means you're missing out something. The general public, I see, what happened to tax rates? Personal tax, oh, not decreased, this not decreased. Your objective should not be that. Look at the budget and look at the economy. As a chartered accountant, you should be looking at a perspective which is bigger. Somehow you are not increasing your pace. You just want to see GST, income tax, audit, deadline 31st March, 31st October. Hey, what happens now? Like that's a labor work. Systems will do that work. When you're doing anything, I'm saying it, whatever has happened. Whenever in life you do anything, remember that whatever you do restructuring, what is the impact which comes out? At least the news items. Some companies are talking about right issue. Right issue, I am presuming to be very, very important. Although questions have been asked very recently also. Maybe because in 2021, there were n number of companies which came out with the right issue. Now again, we are seeing the same trend which is coming out. In exam, how would they come and what would they ask? Rights issue. It's nothing but when the company issues new shares, the shareholders have the first right to apply for those shares. Existing shareholders have 3 choices. If you do not have any account, if your parents have, you can ask them if they are holding any of the share of if they have got any rights issue and tell them it was only for educational purpose. Otherwise, they'll say focus on your CA exam. Do not go here and there. Just tell me in my course it comes. Tell me what happens. That way you can be smart enough. Otherwise, they'll feel that you're going in the wrong direction. Exercise the right, sell the right, or ignore the right. If you sell the right, your wealth will not change at that point of a time. But if someone would have sold the right in Suzlon, he can only understand what has happened to him. If he has ignored, then certainly I am saying, certainly he cannot even forget 5 rupees right issue came, and you can see the price which has happened now. Exercise right means hold. In this case, it's better off since you get what price you sell, that's okay. That's perfectly fine. I get scolding from my father because he got the right issue and I sold. I sold after applying for right, he got the right, he made money also, but undersold. The pain in the market is you make profit, still you are under pain because you could have made more. That pain never remains. Every night he'll remind me, there was what was the use Suzlon, and he has a habit of holding shares for 20 years. The new generation is not. Anyhow, come back. If person ignores the right, wealth would decrease. Let's look at the question. I have taken 2 types of question. One is reverse calculation, one is straightforward. What will come in the exam? One important part which I think theory world would miss, which is difficult to capture from the practical side. Rights are listed and maybe the right price do not justify what is the theoretical price. As per the theory, it's a straightforward that when the rights come in, after the rights are entertained, the share price automatically gets adjusted. It cannot happen that, for example, today price is 200 and if the rights is, for example, IBUL Housing Finance, I think price was 210 or 220 before the last date of the right. When the rights came, the price automatically fell down to adjust according to the right. Because it cannot happen that you keep getting new shares and price keep increasing. At one point of a time, they will adjust, and after that, as per the demand and supply, automatically price starts moving in. In exam, the questions which come, conventional question is number 36. Question number 30. This is the conventional question which comes in the exam. It says shares of Galaxy face value of 10 being quoted at 24. The company has a plan to make right issue of one equity share for every 4 shares currently held at a premium of 40% per share. Basically, the 40% premium would be with respect to face value. Right price would always be lesser than the existing market price. Understand why? Because if your right price is above the existing market price, who will buy the right? No one will buy the right. Will buy the right only when it's lower. That means right issue is coming at what rate? 14 rupees it is coming at. Now, important part is, let's do it verbally please, without any reading of the points what he's saying. Let me do some number game. How many? What is the right issue proportion? 1:4. How do you read 1:4? 1 share for every 4 share. That means if someone is holding, what is the current market price? 24. If you are holding 4 shares of 24, it is as good as buy 4 items of 24. You will get 5th item at what? 14 rupees. What is your average price? Understand what I am saying please. Theoretical price after the right is nothing but average price. You are holding 24 into 4, you will get 1 into 14 divided by 5. What is the price which comes? 22 comes out. Now first part he says determine the minimum price that can be expected of the share after the issue. That will be 22. Second says calculate theoretical value of right. Now what does it mean, sir? Actually, what is a right? Right is nothing but on paper or on mail. Now on the mail it comes, or physically on the paper is to come. For example, I was Able Housing Finance gave 1:2 I think right issue. If I was holding, let's suppose we are holding 1000 shares, we'll get the right of 500. They'll write these are the rights. On 500, they asked for only 50. Total price was 150. All they asked only, let's suppose 150 only. Let me take 150. They said 500 into 150, pay us and get these converted into what? Shares. If I take that paper and apply now, online it is, application happens, it's called ASBA. I can go there and I can fill up my demat account details and the depository details and so on, and I can apply that I am applying the rights, and I can fill up the rights. If I apply, I'll get the right. Otherwise, these will be listed. When they were listed, for example, the right was listed for the India Bull, I could have done what? I could have sold. Let's suppose you bought. Now you will pay whatever market price, that to me, plus whatever amount the company is asking, you'll have to pay to the company. For example, this 14 rupees, whether I pay, I'll get 1 share, or I give it the paper to you, you give 14 rupees to the company, you'll get this. Now, if I give you the paper, you apply the share to the company, in how many rupees you'll get the share? 14. Whereas, what is the market price? 22. How much gain you have? 8 rupees. Basically, that 8 rupees I have to charge from you. Understand what I'm saying? Basically, that 8 rupees I've charged from you, I can calculate in 2 ways. I can calculate theoretical value of a right 2 ways, and 2 type of answers you can give. One is basically this 22 minus 14, that is 8. That is the value of full paper. Or if I divide this by 4, that will be per share. Please understand what I'm saying. I got a paper in which I have a eligibility of 14 rupees. You come to me and say, sir, give this paper to me, I'll apply the right. I am not a charitable institution. I'll say, how much rupees you'll get for? He says, I'll get for 14. I say, whereas the market price after the right would be what? 22, and you will get at 14. Fundamentally, you should not be at a loss or gain, and I should not be at a loss or gain. How much you are gaining? 8. I'll say, give 8 rupees to me, take this paper, apply the right at 14. So basically, what is the value of that paper is theoretical value of the right. I say it's a X right price minus what? Right price. 8 rupees, that is paper. Somehow your institute writes second way, he writes 8 divided by number of shares. Per number of share it will be 2 rupees which comes. That's second way. So if I show you the second part answer, you do not flip over the pages, please look up. You do not look up. We call it as, it was face value 10, issue premium 40, issue price would be 14, right price would, after the price would be 22. And another way, let's look at if you ignore this right at 14, you know what will happen. You were holding shares of what? 20. No matter what mathematics you do, you were holding share of 24. Price will become what? 22. If you ignore the right, your loss will be 2 rupees into 4, 8. So that means that paper has to be sold for how much? 8 rupees. That is called value of right. Value of right would be X right price minus right price. So if I tell you the right, it's 8 rupees. Some have tendency to calculate per share. That's another way out. That's second way of calculating the right. If by chance exam you forget the formula, everything, just think logically that if I ignore and if I am not able to apply for the right, how much is the loss coming to me? That is the value of that paper. Third, he says, show the wealth of the shareholder. Let me do, you have the numbers with you. How many shares he is holding? 1500. Is that fine? Before the right, what was the price? 24. That means your wealth was what? 36,000. On 1500, 1:4 ratio, how much you will get? 375. That means the paper will write, you are eligible for 375 rights. That means you have the right is the right adhikar. You are eligible for that right. Pay us 14 rupees and get 375 shares. I want to see if I sell these 375, I would be charging someone into 8. How much? 3000. That means either I sell this for 3000. If I sell this for 3000, I would not be at loss. Sir, why I would not be at loss? This 1500 share value will remain what? 22. So 1500 into 22, 33. And if I sell for 3000 that entire paper, 36. This is a general mathematics. Technically, how do you put now? Technically, you put is impact on the wealth of the shareholder who has 1500 share and he sells the right. He sells the right. Value of the share before right is 36. If you sell the right, indirectly or directly, answer has to come 36. If it is not coming, you are making a mistake. If I would have done without looking at this data, I would have said after right, my value would be 22 into 1500 shares. That's 33. That means how much is going? 3000. I should be ideally selling that for what? 3000. And if you divide 3000 by 375 rights, you'll get what? At 8 only. So if you get 1500 into 22, that's 33. Right sold is 3000, and I have shown the calculation here. 375 into 8. That comes 3000 rupees. Or second way, if he ignores the right, if he ignores means he forgets what is happening. If he forgets value before was 36, after right would be 33. Do not try to remember any formula. Just remember, the general confusion which I have seen in the right is you are not able to, students are not able to understand that the 8 rupees is respect to what? 8 rupees is the price of that paper. If that paper is with me, I can get 375 shares at 14. If that paper is with you, you can get 375 shares at 14. Basically, a 22 rupees item you will be getting at what? 14. So, how much you are gaining is 8. 8 into 375 is nothing but it's the right has to be sold at. That this 8 answer, how do we get? If by chance you have a habit, since in the books you will find this answer, it is nothing but a 2 rupees which comes. This is a formula, price minus right price divided by n plus 1. This is the way you remember the formula. My way of remembering is straightforward. The right x right price is 22 and on the paper price is what? 14. This is the entire paper 8. If I want to calculate per share, divide this 8 by what? 4. That's it. If you want to calculate. Now, how do I apply, sir? That paper would be sold. The number of rights are 375 into 8. So, it basically means if I am giving you that paper, you pay me 8 rupees and you pay 14 rupees to the company. Your costing would be 22 and I would not be at a loss because I have sold my rights. So, it has to accordingly manage. In this case, there is nothing called a partly paid, etc. The India Bull was a partly paid. Generally, we have a partly paid. Today, I think South India Bank might have issued the right issue. So, right issue has become very, very common because it is one of the actually we are in a kind of a bull run, and it's easy to raise money, and public is getting a right issue. They are getting a part of the new equity, so they are applying also very aggressive. And after Suzlon case, no one wants to miss out the right issue. I mean, it's frankly no one want to miss out. But Suzlon was an exception, and I want you, when you get time, please read about Suzlon, the problem it was in, and what was the price. I think maybe 100 or 200 rupees 15 years back. This price is nothing as of now. It came back to as 2 or 3 rupees some time back. Then restructuring happens. What is the kind of a restructuring? What you do in the accounts? So when you write off the expenses, losses, your balance sheet becomes neat and clean. And once it becomes neat and clean, then if the business is good, then automatically that runs off. But it has already reached at a very high market value. Market cap of the Suzlon is very high. HCC is still, the market cap is lower. So read some of these companies, you'll come to know the internal reconstruction, you'll come to know how the finances are raised, then what are the creditors, what debtors have assumed, they have taken over some liabilities, they have written off some, etc. Some assets have been done, some banks have forgone their loans and have agreed for some haircuts and so on. These are the restructuring, and right issue is the fresh raising of the money which happens. Now look at the answer, then one question, reverse calculation, I'll ask you to do. Question would be, if you sell the right, no loss. If you exercise the right, no loss. If you ignore the right, there is a loss. So generally he'll frame these three questions. Quickly look at the answer. One question there, 49th, I think, reverse calculation. Try that out in case you've done this. 49th, I think, or 49th. Aggressive Limited is proposing fund its expansion plan of 12 crore by making a rights issue. The current market price is 40. Ford is willing to offer 20% discount on the current market price for right issue. Try that out, please. Look at this. Today only, I think all papers have covered. When you go back home, open up your papers, any paper. Just today's article only. South India Bank shares rise after board approves right issue. I don't know why the price goes up. But anyhow, India Bull also went up. Maybe people want to form part of the right issue. They buy at this rate, they'll get the right issue. So this is how exactly happens. When you go back, you can open up anything. You'll come to know exactly what has happened. For example, once you come to know any news, then you can open up The right will open up on 6th March, and I think they are planning to raise later issue these many shares. Right issue is fixed at what? 22, which is discount of nearly 35% of the closing price on Wednesday. Today is Wednesday, Thursday. Today is expiry. Yesterday was Wednesday. This will issue at 22 per share. Now what they are trying to do is, I think February 27 has been fixed as a record date. That means for buying till that time, they'll get the shares and they'll be eligible for rights. Basically, they are buying, and because of that pressure, the price would have gone up. When you go back home, I'm saying any paper you pick it up, you'll find these items. So everywhere they'll cover it up. Tribal Housing Finance, if I show you, that also came. Housing rights issue. The issue price was 150, but they've only asked for, I think, 50 as of now. This happened some time back, not very long back, sometime more, 10-12 days back. Right issue is very common. I'm assuming any smart examiner making a paper will make from the recent trend. He has to make. If he is not following recent trend, then it's okay. Then whatever you have a conventional paper which is coming in conventional. Even internal reconstruction becomes important. I'll give you some size in the M&A and valuations, because that is also happening very aggressively in Indian markets. We need to follow the trend, what is happening. Aggressive Limited proposing expansion of 12 crores by making a rights issue. The current market price is 40. Board is willing to offer 20% discount on the current market price. The board is also desirous that fall in the ex-right price of the share restricted to 10% of CMP. Calculate the number of equity share to be offered. I think it's a reverse calculation only. So basically, after a fall, the right issue is coming at what? 32, and fall in the price you're expecting what? 36. So 36 basically average price should be equal to how much is the right? You don't know, na? What is the price as of now? So this equation has to be solved basically. 32 into rights plus 1 plus right and so on. You can solve it out and you can get the reverse. 1 is to 1 is to 1. That's the reverse calculation. Done. Now let me show you some ambiguous language, one or two. Although in the recent time institute has corrected, hence I did not cover it. They have corrected the language. But if by chance you look at some old questions which I have not covered for the purpose, because I am presuming they are trying to improve upon the language front. Was the question which came long back. The question had a problem. I think they have corrected in the recent size. Shares of a Voyage Limited are being quoted at a price earning ratio of 8 times. Company retains 45% of its earning, which are rupees 5 per share. This language would be there in some of your notes, maybe those who would be referring. This language they have modified in the recent time, because when they say the company retains 45% of its earning, which are rupees 5 per share, it's not an English paper we are writing. We don't even know whether what they're talking about. Retains 45% earning, which are rupees 5 per share. 5 is a retained earning or 5 is a EPS. So I think in the recent trend they have used the company retains rupees 5 per share, which is 45% of its earning. So by chance, if someone has any material, any examination pattern, any suggested, if you look at, you can find these kind of languages. Second is, in the above languages, it's difficult to make out whether it's a forecasted or historical. A general trend, if I look at the seventh question language, the company retains 50% of its earning per share. Language is clear. Now retains, or second question I have, the, for example, fifth, price earning ratio of 7.5 times the retained earning per share being 37.5 per share is this. So these kind of a question, general trend we have seen, they assume as a expected to some extent. Although I think they should be giving marks for the historical also. So whatever the trend they follow the trend. Some general convention becomes over a period of a time. So ambiguity used to be there in questions. Over the period I've seen some of the ambiguities they're trying to remove, but it takes time. Problem happens is because when examiner makes a paper, he will have entire data sets, and there could be possibility he might see the 2011 paper and accordingly he frames a language. So that language problem can come, which is not there. If you look at the recent study material, they have I think corrected is this was one ambiguous question which you should be doing. Second is Piyush Lunkar and associate. This question came in May 2001. I thought they'll remove it from here, but they have not removed. In your case also, no matter which books you could refer, this question will be there. This question maybe just before your batch, I could have said that it's okay if you ignore, it's perfectly fine, because this has a link with the capital budgeting. So this has slight link with the capital budgeting. In case you've done anywhere, just this word will be exactly same, Piyush Lunkar and associate. The wordings also would be same. It's a 2011 question in which you have to reverse calculate the KE. I think it's a calculation of a KE. So this question you can mark it. The names you should remember: Piyush Lunkar Associate, Voyage Limited. And third, which I did not take up, maybe I thought every one of you would have, is a Seawell Corporation. This also will be there in your study material. Seawell Corporation. And fourth, I told you DAC. So these four questions are important. Voyage Limited. Now I think Voyage Limited has become Volga Limited. Yes, Volga Limited. They have to change slightly. Like Piyush Lunkar has remained Piyush Lunkar because he has not asked in the exam. Almost before your birth, this question came. This question would be a combination of the capital budgeting plus I think the security valuation. Slight IRR concept is used since you have a capital budgeting, so there could be a question might ask. This question would be there 100%, no matter which book you are referring. Seawell also would be there because Seawell and CMC PLC, what we covered in the beginning of the class, came nearby in the examination. Seawell Corporation, this you can try out from your books. And one question which I told you was another one, DESC. Zumo Limited we have done, DESC. In case it is not there, it's perfectly fine. This question I'll tell you briefly what it about. It says for 5 years they will not pay the dividend. Then from 6th year end they start paying dividend, and earning rate changes after 5th year, and from 6th to infinite some rate comes. The objective is, he says, when the company is not paying dividend for 5 years, what do you expect price to happen? What we have done in the SAM Limited question, the price would increase at the rate of K. More or less it's similar pattern which comes. Abhishek Limited we have taken, that's it. So more or less we have covered. One more question if you want, if you have a time, which your institute has done. I'll just briefly discuss. I think they have done, although there could be alternative opinions on that. It's again an ambiguous question. I'll just quickly discuss with you. Please. Question number 48. Actually, two type of answers can come. I'll just quickly discuss out. This is ambiguous. It's a May 2023. If you look at it, says an investor is considering purchasing equity share of Alpha Limited, whose current market price is 172.45. You will not have this question. You can see from my book only. The company is proposing a dividend of 6 per share for the ending 31st March 2024. No doubt on that. 6 per share is D1. Alpha Limited is expected to grow at the rate of 20% per annum for next 4 years. Thereafter, growth rate over next 3 years, what you were asking, next 3 years will decline linearly by 100 basis point. That's a clear-cut language. Thereafter, it will stabilize at a certain growth rate per annum infinitely. This growth rate is not given. This growth rate is not given. The required rate of return is 20%. Dividend value 2 decimal points. calculate stable growth rate after 7 years. Now that was an ambiguous question. I don't know how they said this kind of a question. There could be alternative opinions which can happen. If I would have shown you, frankly, the first part, if I would have shown you the one way of doing, actually problem was I do not know to calculate stable growth rate of alpha after the end of 7 years. And if you look at how much is the growth for 5 years, 20, 20, 24 years, 20, and then what? 19, 18, 17, and actually second part, the second part I have done first. Advise whether it is worth to purchase the share at this price if it has a stable target of 15%. Now what target he was asking, which period he was asking, what rate he has to calculate. So this was one opinion, but the answer which was given was very surprising, which the institute gave. This price is 172.45. Now what he did was, he has done, if this is my circle here, let's suppose, what he did was, can we calculate D1, D2, D3, D4, D5, D6 and D7? Let's calculate D1, D2, D3, D4, D5, D7 using this number. Calculate for me. I'll write it here only. 6 is your D1 given. And then you can add 20, 20, 20. D1 would be 6. D2, tell me. 7.2. D3. 8.64. D4. 10 point. 2 decimals will point. 37. Then 12 point. 12.44. 34. D6. Actually, I don't know. That will change na 19%. Linearly decline, please. No, 20% is not there na. 20% for first 4 years and then what? Linearly decline. 19, then 18, and then 17. 12.34 after that. 14.56 after that. 17.04 na. You can also do me a favor. Decimals are given to you. Calculate the present value. Multiply with the present value factors and calculate the present value. We are not doing second part, we are doing the first part only. Even second part was ambiguous, first part was ambiguous. I am assuming institute should not be setting these kind of paper. First part I will tell you because this is the first time they have given this kind of a thinking. Just multiply, how much do you get present value of dividend? 0.833 into 4 decimals only he has given. How much do you get? 34.59 or 34.60 approximately you will get. This is exact question I have taken May 23 and I was surprised to see the answer. Means it was very surprising because second part he says 15%, he could have given first as this, or he could have assumed this is the fundamental price. If he would have said no, instead of current market price, this is the intrinsic value, my life would have been very easy for me. 172, because I do not know whether 172 is the intrinsic value or whether it's a current price. Or he could have said the share price is fairly priced, that means fundamentally it is appearing at a right price. Now what way of doing second part answer was, since we calculated how much, 34.6 now, current market price is 172.45 which was given, minus 34.6, that means PV of P7 will come. Basically this will be nothing but PV of P7, present value of price 7. Actually how do you calculate current market price? Current market price is nothing but it's a present value of dividend plus present value of price. So what I have to do is I have to calculate this growth. So if this is my present value of price, balancing figure they calculate as present value of price, that's 137.5, and present value of price is nothing but its P7 is D7 into 1 plus G divided by K minus G into the present value factor. I think present value factor of the 7th year was 2.791. This was the present value factor. So reverse calculation was done for the G part here. The G came 16. I hope you are getting my point. What I'm saying, what was done was this first part, the first part which was done using was you calculate d1, d2, d3, d4, d5, d6, d7 and then calculate p7. The language which I am assuming, if the same question comes in the next time, he'll give intrinsic value is 172.45. Fundamentally question becomes right, or he'll write the it is trading at fair price. That means this 172.45 is the correct price. If I subtract from here the present value of dividends, this is balancing figure is present value of price. Since I need to calculate G, I know present value of price is nothing but P7 into what? Present value factor. And P7 is nothing but D7 into 1 plus G divided by K minus G. And when you reverse calculate, you will get G as 16%. Problem remains for the first time. Similar things have happened n number of times. Second time they come to know, because when they solve question on their own, they come to know what was the mistake in the language, and I'm assuming they'll correct this. So May 23 you can put down ambiguous question. Whenever you look at the suggested or anywhere, or you make this is the alternative they have given, but I think there could have been some other alternative assuming the discount rate as a linear declining 19, 18, 17, or you could have assumed 16 as a constant growth. That I could have given the marks at that point of a time. But since they had given a different kind of a scenario, reverse calculation of G, so you can assume this as this comes out. And by chance, if you linearly decline 19, 18, 17, 16, then comes 16 only. But anyhow, that way of understanding and doing this way is separate. And then the stable growth rate was given, I think 15 na, and your is coming as higher. So you can say it's advisable to go for it, or you can show the calculation. So these are ambiguous questions. Voice limited, I think now Volga limited, they changed the language. Piyush Lunkar is basically combination of security valuation, capital budgeting. CVL and DAC are both untouched area in the exam. CVL also, I think CVL Corporation, when you look at in the book, it will have 2 beta. APM model they apply CAPM, RF plus beta into RM minus. That you can. So finish here. Tomorrow I'll take the call whether I'll start with the bond valuation or bond or M&A or a business valuation. Because M&A business valuation is slightly lengthier chapter and it has a link with this chapter, so that could be there, or a bond valuation. I'll take the call. Start the same time, only for tomorrow 5:45. Saturday I'll start early, assuming you have a off from the article check. Start accordingly. Take care and bye.